Hi, my name is Brad Cable, and I am President and a Private Wealth Manager with Bradley Cable Incorporated. I am also a financial advisor with LPL Financial, the largest independent broker-dealer in the country based on revenue. With these presentations, I hope to provide valuable information to people that seek strategies to navigating what has become a very complex financial environment. I encourage you to email or call if you have any questions on the topics presented. A quick contact form can be found in the Contact Us section of our website. Thank you for taking the time. Stepping out of cash. Strategies for putting cash to work. If you are like many investors today, you are holding much more cash than you ordinarily might. You have fled the chaotic markets and you are sitting on the sidelines until things settle down. The problem is, we don't know how long it will take for things to settle down. It could be sooner than you think, and moreover, cash may not be the safe haven you think it is. In fact, as we will discuss, holding too much cash may be putting your long-term goals at risk. In the next few minutes, I'm going to explain to you why overinvesting in cash carries certain risks and may not be a viable strategy for achieving your long-term goals. I am also going to discuss how and where you may put some of that cash to get it back to work, specifically by using bonds. After that, I will show you a few investment strategies that help you to take a small step up in risk in exchange for a bigger step up in total return potential. Then we will wrap it up with some specific next steps you can take. I understand what has been driving investors to cash. I understand the instinct behind this flight to safety, and these are certainly real concerns for trying times. But depending where you are in your investment time horizon, perhaps years away from retirement, or in retirement now, holding too much cash may be giving you a false sense of security. Yes, of course, you want to hold some of your assets in cash, in particular, money for your immediate obligations like your mortgage, bills, and groceries. And you will want to have an emergency fund, particularly in these uncertain times. But beyond that, there are risks to overinvesting in cash. To illustrate, let us take a look at the historically high levels of cash that investors are holding and the historically low levels of return that cash is paying them. Our first chart illustrates where investors' money has been moving and what investors think about the future of the market. It shows how retail money market assets and the VIX, the Chicago Board Options Exchange Volatility Index, a key indicator of expected market volatility, also called the Fear Index, both recently reached new all-time highs. There are some other interesting things in this chart. Cash levels in money market funds stayed relatively flat throughout 2005 and early 2006, but when the housing bubble started to pop in the spring of 2006, cash levels started a steady climb. Look at that consistent trend line from July 2006 through July 2007 as people start to build up their cash positions. Right around the summer of 2007, the subprime crisis hit and the VIX jumped, indicating that investors got quite apprehensive about the stock markets. Things stayed pretty bumpy in the Fear Index for the next year, while money market funds saw even more inflows, as you can see from the steepening line. And then, in September and October of last year, the financial crisis really hit home. Look at how the VIX jumped to never-before-seen levels. A few months later, in January of 2009, money market funds hit never-before-seen levels too. Now, while the VIX has dropped a bit, cash levels are still high. So while investors may not be as fearful of the market as they were a few months ago, they still have lots of cash in money market funds. So what does all that mean to us? The laws of probability tell us that many people are probably doing the same thing. So in a way, you can take comfort, because if you have moved into cash, you are not alone. And it is important to realize that for many people, getting less of a return by being in cash will seem safer than losing money in the equity market. That is certainly understandable. But think about what being overinvested in cash will do to your future purchasing power. Remember that we all have long-term dreams. You probably did not build your portfolio just to make sure you can pay your bills. You have real goals to reach. That brings us to another implication of being overinvested in cash. If you are one of these investors, it means you have undiversified your portfolio, which means you are engaging in that scary proposition known as market timing. You are making an implied statement, either that cash is the only place to be from now on, or that you will know when to get back into the other sectors you have moved out of, like stocks and bonds. This chart shows the yield on the 3-month Treasury bill. which is widely recognized as a proxy for cash. Over the past 3 years, T-bills have dropped from around 5% down to almost nothing, and they even dropped below 0% for a short while. T-bills are an ultra-safe investment, backed by the full faith and credit of the U.S. government, and they are used in money market accounts and other very liquid investment vehicles. Investors have flocked to T-bills because at least they know they are not going to lose their money, and they know what their investment is worth at any point in time. You might be one of these investors, but as I have said in my introduction, there are several reasons why holding too much cash may interfere with your long-term goals, and the first, as shown here, is limited returns. Long-term cash returns have historically been lower than those of riskier investments, and are barely positive today, so an overallocation to cash can limit your potential growth. Do not forget, you need growth to meet your long-term investment goals, like a comfortable retirement, college for your kids, or a lasting legacy. The second risk of overinvesting in cash is inflation, which is a constant risk that erodes purchasing power. Even in boom times, many investors overlook the impact of inflation on their portfolios, so even if inflation is negligible today, who thinks it will not return, particularly given all the government spending? Keep in mind that the current low rate, high spending environment is part of a purposeful move by the Fed. The government is trying to reflate the economy, and it is pulling out all the stops to make it successful. So there is a strong possibility that we will see inflation stemming from the government policy measures as they overdo the response and flood the system with liquidity. The third risk of overinvesting in cash is taxes, which of course take an additional bite out of cash's already low returns. Bottom line, there are millions of people and billions of dollars losing ground sitting in cash. Even though you are not risking losing your principal, you are definitely risking missing your goals. Economic conditions are likely to warrant exceptionally low levels of the federal funds rate for an extended period of time. Here you see a very interesting quote from Ben Bernanke, the chairman of the Board of Governors of the United States Federal Reserve. At the head of the central banking system in the United States, he is one of the chief architects of government's policy response to the market crisis. One of his primary duties is communicating the thought process behind the Fed's decision to move interest rates. As you know, the Fed has moved us toward an extremely low rate environment, so it's a good idea to listen to his words closely. And notice the use of the word extended in this quote. It sure sounds like low rates aren't going away anytime soon. Next, we are going to talk about how a prudent first step out of this low-returning cash environment may be bonds. We will also do a quick review of some bond basics, which will include long-term benefits of bonds such as solid return potential over time and reduced downside risk. To see why bonds may be a prudent first step out of cash for you, take a look at this chart. It is a simple visual depiction of the risk-reward spectrum. On the lower left corner at the intersection of low potential risk and low potential reward is cash. Moving up a notch in risk potential also moves you up a notch in potential reward, which takes you to short-term bonds. Note that this bond sector is very near to cash. Next step up on the risk-reward spectrum is core bonds. There are always good reasons to consider being invested in core bonds, but it is particularly true today. Moving up on this spectrum are certain timely bond opportunities in specific bond sectors, which we will also talk about in a few moments. And you can keep going upward on the risk-reward spectrum until you reach equities and beyond. What this means to you is this. If you are one of the many people who are overinvested in cash, it is probably because you are feeling really risk-averse at the moment. But that also means that you're getting extremely low returns. So if you want to step up your return potential, there is no question that you will have to take a step up in risk. The real question is, where do you want to be on this spectrum? To get you started, we are going to focus on the area right above cash on the risk spectrum. We are going to focus on bonds.